Our second commentator on this session is Bruce Johnson from the University of Iowa, where Bruce serves as the Departmental Executive Officer.
Thanks again for the introduction. My comments this afternoon are going to try and touch on 3 points. First off, I want to offer a perspective on why financial statement analysis is important for both equity analysts and investors. Next, I want to describe 3 distinctly different settings in which financial statement analysis is performed by these analysts and investors. And finally, I want to highlight a gap in our work product, and by that I mean both our research and our pedagogy, when it comes to helping analysts and investors go about the task of conducting informed financial statement analysis. The message I want to leave with you today is captured in the phrase on the screen, back to the basics. I believe our work product can be improved if more attention is devoted to understanding how the economics of a firm's business model and the competitive dynamics in its industry combine to leave a trace in financial statements. Let me elaborate by first describing my view on why analysts and investors care about financial statement analysis. And it's derived from an equity perspective rooted in residual income valuation model. I find that a very useful perspective for a couple of reasons. One, it makes explicit the role of income statements and balance sheets. That's helpful for connecting to accounting. More importantly, for our purposes today, that residual income valuation model puts emphasis on this notion of competitive advantage. That's the bracketed term in the middle of that summation. Valuation in this framework becomes relatively easy if the firm is simply earning a competitive return on its net assets. That summation term goes to 0, and we need only focus on coming up with plausible values for book value of equity. It becomes more difficult when there is a competitive advantage or a disadvantage, and I think that's the heart of what financial statement analysis ought to be trying to do in this context of equity analysis and investment. I want to be careful today to restrict my remarks to situations where the data, the accounting data themselves are relatively pristine. That is, I'm not interested this afternoon in talking about instances of intentional distortion for good or ill, as Jeff pointed out, but rather instances where the accounting system could potentially still have distortions embedded in it, but those are the typical distortions, things of the sort like historical cost accounting in periods of rapid inflation, those kinds of things. So in my view, the key question that confronts equity analysts and investors is really twofold. Does the firm have a competitive advantage? If so, the trace ought to be left in a return on equity exceeding the cost of equity. And if so, what's the source and durability of that competitive advantage? For example, is the source high customer switching costs for a company that does enterprise resource planning software development? Is the source of that competitive advantage a first mover, as is the case in retail stores like Walmart's original business model? Or is the source of that competitive advantage the ability to correctly anticipate fashion trends in women's apparel manufacturing? Of those 3, I suspect the least durable is that latter ability, the ability to predict fashion trends, because the product has a short life cycle and because there's intense rivalry in that industry. So it's what's the source? What's the durability? Let me now turn to these three distinctively different settings in which financial statement analysis occurs. Some would argue that I may be talking about endangered species, but I hope that's not the case. My starting point is one that I think we're all very familiar with and we tend to anchor on. These are either sell-side or buy-side specialists at relatively large institutions. And the way I think about it is there's a team of analysts that are following perhaps just 10 or fewer firms. The kinds of analysts that I want to talk about today form recommendations and target prices derived from detailed financial models of each covered firm, and they'll typically use a theoretically sound valuation calculus in deriving those target prices. Frankly, we have very little to say to those analysts and investors who don't follow this kind of rigorous approach, except stop doing it. The second group that I would like to talk about are mid-sized money management firms. And again, to give you some perspective, this is a firm that may be managing $1 billion, but even at that scale, there are likely to only be 3 analysts working in the firm, and the portfolio may contain 50 stocks. So the scope of their coverage is substantially larger than is the case in that first setting. Moreover, there may be as many as 700 firms that comprise the universe from which they need to examine portfolio candidates. 700 or more stocks currently, for example, with a market cap of in excess of $4 billion. Money management firm that I want to talk about this afternoon will use a third-party valuation platform and accompany that platform with perhaps other platforms that facilitate the financial analysis portion of what they're doing. Both that valuation platform and the analysis platforms are just starting points for their work, but you can see the challenge. 700 stocks and only 3 analysts. And finally, at the far end of the spectrum are quantitative investment shops. And by that I don't necessarily mean hedge funds. And again, the prototype for our purposes today, 3 analysts, a large and diverse portfolio, rebalanced often. Stock selection is being driven by a multi-factor model of excess returns. So let me now turn to that first setting. And again, think through in the context of a residual income valuation model, what is the task confronting the sell-side analyst or the buy-side analyst/investor? The task is to come up with this target price, that V naught on the left-hand side. That target price is going to be driven, if we're thinking about future aspects of performance, by really 3 kinds of things. That spread term, reflecting a competitive advantage, the ability of management to use assets and earn a return in excess of the cost of capital. By growth, and that growth could be top-line growth without additional investment. It could be growth accomplished through plowing back into the firm, the earnings retained periodically, or from new investment. And the third driver here is duration. For how long into the future will that positive spread and that growth persist? So how do analysts who adopt this perspective go about the task? Well, first of all, they tend to build very detailed financial models of the company. If you look at an analyst covering the GAAP, for example, you might find a detailed financial model of Old Navy, a separate detailed financial model of Banana Republic, a detailed financial model of the Gap stores themselves, as well as any e-commerce initiative, all rolled up into a series of forecasts intended to capture spread growth and duration in this competitive advantage sense. These analysts will take a microscopic examination of financial reports and disclosures. Their forecasts will be grounded in a very rich set of contextual information about what's happening in the industry, management strategy going forth, and so on. And finally, that stock recommendation or that stock selection decision is based on this comparison between V, the target price, and P, the prevailing stock price. V over P matters a great deal in this kind of setting. Well, again, the point here is to walk you through what I think most of us would like to believe the buy side and sell side at these large institutions are really doing. Let me turn now to perhaps a less familiar context, and that's this mid-sized money manager. Again, some key attributes of that setting. First of all, a reliance on these third-party platforms. And these platforms provide real-time fundamentals. That is, they're updated as quickly as the electronic databases are updated. Provide real-time consensus earnings forecasts. We're seeing more of these platforms also capturing analysts' sales forecasts. And there's the valuation calculus as well that's lurking behind that platform. Stock screens are a very common approach used in this setting to narrow the set of firms for which analysts can devote more detailed attention. Financial statement analysis graphs, charts depicting trends in key variables, are also critically important in this setting. They provide a snapshot of past performance, and they also provide red flag alerts on either changes in performance or quality issues. Of course, the key question that confronts people in this setting is, what exactly do I look at, and when should I be concerned about what it is I'm seeing in these charts and graphs? It's been my experience that there's very limited use of traditional microscopic financial statement analysis tools and techniques. People in this setting rarely get to the footnotes simply because it's so time-consuming to do so. However, the valuation model forecasts themselves must still capture somehow expectations about competitive advantage. Here's a screen clip from a web-based system sold by Applied Finance Group. And I apologize that the clip is as small as it is. Let me kind of walk you through it. This happens to be data on Campbell Company, and the stock price was as of, I think, Wednesday when I put this together. What you're seeing, let me see if I can.
Bruce, we're close on time.
Okay. I was afraid of that. What you've got is a price target, a competitive advantage period. You've got forecasts being rolled through. This blue bar in the middle is an indication of the firm's competitive advantage. That's the extent to which a proprietary return on capital is exceeding the cost of capital. You'll notice with Campbell's it's flattening out going forward. Let me do one other slide. This is a clip of another online product sold by StarMines. And it illustrates the kind of charting you see. On the left panel is a chart that's trying to convey information about accruals versus cash flow components of quarterly earnings. On the left, or on the right-hand side, is a comparison of the firm's return on equity versus the sector return on equity. So again, a more visual appearance, but the fundamental question remains, what should I be looking at and when should I be concerned? I have some other comments, but I will postpone them for later.